Warren Buffett's Berkshire Hathaway has just hit a massive milestone, a $1 trillion market cap. And get this, they're the first non-tech company to join this exclusive club. Pretty impressive. We're going to look at how Berkshire Hathaway achieved this feat, check out their stock performance, and why we recently bought more shares on top of those that we picked up at the start of the year. So let's kick things off with that $1 trillion market cap. Berkshire Hathaway is now rubbing shoulders with some serious heavy hitters. We're talking Apple and Microsoft with their $3 trillion plus market caps, Nvidia sitting pretty at just over $2.5 trillion, Amazon and Saudi Aramco flirting with that $2 trillion mark, and Meta at $1.2 trillion. Berkshire Hathaway has officially become the 8th most valuable company in the world. Not too shabby at all for a company that actually started out in textiles. Now, for those of you who might not be familiar with Berkshire Hathaway, let's do a quick crash course. This American holding company is a conglomerate that includes over 80 companies. We're talking a wide range of businesses here: insurance, rail freight, energy, financial services, manufacturing, wholesale, retail, you name it. Berkshire Hathaway probably has a finger in that pie. And at the helm, none other than the legendary investor and multi-billionaire Warren Buffett. Let's talk about Warren Buffett's track record for a second. He has delivered a compound annual return of 19.8% for nearly 60 years, outperforming the S&P 500 index. His longevity is second to none. To put this in perspective, if you had invested $1,000 in Berkshire Hathaway when Buffett took over, you'd be sitting on more than $40 million today. You heard that right, $40 million, not a small number. Still think your savings account is the best place to keep your money? But to put this into perspective and why we at Sublime Trading focus on trend following, which is buy high, sell higher, and not value investing, which is buy low, sell high, note where Warren Buffett comes in this performance table. Trend following has topped performance tables for decades, whereas value investing is mid-table. The irony, as you will see at the end of this video, is that we are using a trend following strategy on a company that focuses on value investing. If you are value investing, you would very likely not be looking at Berkshire Hathaway because you would be looking for stocks that appear to be trading at a discount or underpriced. Therefore, you would be missing out on good profit right now from Berkshire Hathaway's recent stock performance. Now, here's a fun fact that might surprise you. Berkshire Hathaway wasn't always the investment powerhouse we know today. It actually started as a struggling textile company in Rhode Island. But in 1965, Warren Buffett and his investment firm swooped in, took control, and transformed it into an investment holding company. Talk about a glow up. Berkshire Hathaway's first major acquisition was Nebraska Furniture Mart in 1985, followed by the reinsurance giant General Re Corporation in 1998. Buffett's strategy: diversify, diversify, diversify. He kept his eyes peeled for attractive opportunities, and it has certainly paid off. Between the 80s and 90s, Berkshire Hathaway's stock price shot up by over 40,000%. That's not a typo, 40,000%. Now, let's fast forward to today. Berkshire Hathaway has its fingers in so many pies, it's hard to keep track. This diverse portfolio spanning multiple industries gives them a unique position in the market. It's not just about making money, it's about generating long-term value for shareholders. And that $1 trillion milestone, it's a testament to the strength and stability of Berkshire Hathaway's operations. But Buffett and his team didn't stop there. They made some bold moves over the years. Take the purchase of Burlington Northern Santa Fe Railway in 2009, or the acquisition of Precision Cast Parts Corporation in 2016. These weren't just random buys. They were strategic moves that expanded Berkshire Hathaway's presence in key industries and drove its financial performance through the roof. The result? Well, since the early 2000s, the stock has climbed another 750% to its current all-time high. I don't know about you, but my calculator is smoking just trying to keep up with these numbers. Now, let's talk about Berkshire Hathaway's stock classes, because this is where it gets interesting. The A-class shares are trading at around $700 $700,000 per share. Yeah, you heard that right. $700,000 for one share. No wonder the daily average volume has dropped to around 2,000 since June. Not many people have that kind of cash lying around. But here's where it gets even more mind-blowing. When Buffett took over in 1964, there was just one class of shares, Class A, and they were trading at about $19. Let that sink in for a moment. From $19 to $700,000. If that doesn't make you want to start investing, I don't know what will. Now, Buffett had an interesting philosophy about the high share price. He once said, "I don't want anybody buying Berkshire Hathaway thinking they can make a lot of money fast." He was all about attracting long-term investors who weren't worried about day-to-day fluctuations, just like we are here. But by 1995, with Class A shares over $22,000 a pop, there was a growing demand for more accessible shares. So in 1996, Berkshire Hathaway introduced Class B shares, affectionately known as Baby Bs. These were worth 1/30th of a Class A share and had a 1/10,000th of the voting rights. It was Berkshire Hathaway's way of letting average investors get a piece of the pie without going through sketchy unit investment trusts. Fast forward to 2010, and Buffett split the B shares 50-for-1 to help pay for the $27 billion acquisition of Burlington Northern. Now, B shares are worth 1/1500th of Class A shares, but still have the 1/10,000th of the voting rights. So, how does all of this translate into Berkshire Hathaway stock performance, and why have we been buying since the start of the year? Well, first off, Berkshire Hathaway tends to buy back its own stock more than any other. It's like they're putting their money where their mouth is. But here's a point to note, as the stock has jumped around 30% year to date, Berkshire Hathaway has actually pulled back on share buybacks. In fact, their repurchases hit their lowest level in over 5 years in the second quarter. At the same time, their cash hoard has skyrocketed to $277 billion, partly because they dumped a big chunk of their Apple share. Now, you might think Buffett would be using that cash to buy back more stock or invest in the market, but nope, he's parked $235 billion in treasury bills. It's like he's saying earning a 5% yield from treasuries is a better deal than buying back his own stock right now. According to Buffett's favorite valuation metrics, price to book value, Berkshire Hathaway is looking pretty expensive. It's approaching 1.7, way ahead of the 1.2 that used to be the threshold for repurchases. But here's where I might disagree with the Oracle of Omaha. Regardless of what you, me, or Warren Buffett think, the stock market is heading up. Berkshire Hathaway's stock price is climbing, and it's likely to keep doing that going forward. Let's apply our 4PS method to Berkshire Hathaway. This is a systematic approach we developed to significantly enhance our stock picking and timing for entering and exiting stocks. All stocks we invest in go through 4 key phases, with phase 4 being where we enter. Phase 1 is a proven performance history. We saw a phase 1 from March 2020 to March 2022 with a 127% increase. That's a solid performance, but one we should expect for an established company like Berkshire Hathaway. Remember, if a stock has performed well in the past, it's likely to keep performing well in the future. It all starts with stocks having a good phase 1. Phase 2 is a period of consolidation, which was from March 2022 to December 2023. Think of it like the roots of a tree. The longer and thicker the roots, the taller and stronger the tree. This is where the saying, the longer the consolidation, the bigger the breakout comes from. Building a watch list of phase 2 stocks is crucial for monitoring which ones break out into an uptrend first. January 2024 marked phase 3. This is the confirmed breakout from phase 2 and when we prepare to buy. We apply patience to avoid a fake breakout, which is when a stock moves back into phase 2 and starts moving sideways again. Phase 4 is when the uptrend is confirmed. Berkshire Hathaway's current phase 4 uptrend has climbed 28% since the start of 2024 and when we first started buying shares. So when should you consider buying Berkshire Hathaway? Well, it's recovered 18% from the August declines and is setting new all-time highs. That's when we started buying more shares, adding to the shares we bought at the start of the year. As a pro tip, buying more of a winning stock is called compounding, and how the finest traders and investors boost the profit of top performing stocks. And by eliminating the risk on the previous position, we add more shares into the portfolio without adding any more risk. Smart, right? Berkshire Hathaway is now closing in on $500 per share, which is an important level that could either push the stock price down or create another phase 2 base, at least in the short term. If you're not in this stock yet, keep an eye out for a dip back towards the previous all-time high of July. That could be a good buying opportunity. Or if it breaks above $500 convincingly, that could be another chance to get in. If you think the performance of Berkshire Hathaway is impressive, you should check out my top 5 stocks for September. They have had a solid profitable run so far this year, but it's still not too late to add these to your portfolio. So click on this video now to watch.